Wait. You wake up, check your bank account, and that number quietly shapes almost every part of your life. It affects what you eat, where you live, how you feel when bills come in, whether you sleep peacefully, or lie awake at 2 a.m. trying to work out how everything is going to fit. In Australia today, the average household net worth is around $1.66 million. But averages can be misleading, because behind that figure are people deciding whether they can afford groceries or petrol. And on the other end, there are people deciding whether to buy another investment property. In this video, we're going through every level of wealth in Australia, from the poverty line all the way through to the top 1%, so you can work out where you stand and what it takes to climb higher. Level 1. Below the poverty line. Let's start with the level nobody wants to be in. Right now, around 1 in 7 Australians are living in poverty. For a single adult, the poverty line is about $584 a week. At this level, there is no saving. There is no investing. Every dollar is already allocated before it even arrives. You know exactly when supermarkets start discounting food. You know the exact balance in your account at all times, not because you are good with money, but because one unexpected cost can throw everything off. A dental bill, car registration, a broken washing machine, any of those can completely derail your month. At this stage, money feels like a constant source of pressure. You're not trying to get ahead, you are just trying to stay afloat. Level 2, getting by. Now let's move up to what a lot of people would call getting by. You have a job, maybe full-time, maybe casual. You are earning around $55,000 to $65,000 a year after tax. That works out to roughly $850 to $1,000 a week. At first, that sounds fine, until you realize the median rent across Australian capital cities is now around $650 a week. And in Sydney, a unit is closer to $760 a week. So if you are renting in a major city, half, or even more, of your pay can disappear before you buy anything else. You might have around $10,000 to $15,000 saved. Most of it is probably sitting in a savings account, doing very little. If you are in your late 20s, your super balance could be around $25,000. At this level, you can survive, but you still feel stuck. You're working hard, but it feels like the finish line keeps moving further away. Level 3, the middle. This is where a large part of Australia sits. You are earning somewhere between $76,000 and $100,000 a year. That is around the full-time median income range in 2026. You might own your car outright. You could have an emergency fund of $15,000 to $30,000. If you are in your 30s, your super may be sitting between $55,000 and $90,000. You might also be trying to save for a home deposit, and this is where the numbers get serious. The median house price across Australian capital cities is now around $1.014 million. A 20% deposit is more than $200,000. Even a 10% deposit is still over $100,000. So if you are putting away around $1,500 a month after expenses, that is $18,000 a year. At that pace, it would take over 5 years to save a 10% deposit, and that is assuming property prices do not keep rising. Which they probably will. At this stage, everyday life is manageable, but the bigger goals still feel a long way off. Level 4, the traction zone. Now we move into the stage where people finally start getting some momentum. Household income here is usually between $150,000 and $250,000. Most of the time, this is a dual income household, maybe two people both earning between $80,000 and $120,000. This is the point where saving becomes much easier. You might be putting away $3,000 to $5,000 a month. You may already own your first home, or at least be close to buying one. If you purchased before 2023, there is a good chance you already have decent equity. Your combined super balance could be around $200,000 to $350,000. And outside of super, you might have another $50,000 to $100,000 in savings or investments. This is also where you start thinking differently. You begin looking at ETFs. You might salary sacrifice into super. You may even start planning for an investment property. You stop focusing on survival and start focusing on strategy. Level 5. Top 10%. To be in the top 10%, your individual taxable income is usually above $137,000. Your household net worth is likely somewhere between $1.5 million and $2.5 million. You probably own your home, and there is a good chance it is worth more than $1 million on its own. You may also have an investment property bringing in rent. Your super balance could be anywhere from $300,000 to $500,000. You probably own shares, ETFs, or managed funds as well. At this level, you can afford better holidays, you can buy higher quality things, and you are not stressing about every small expense. But here is the strange thing. A lot of people at this level still do not feel rich. Because there is always someone with more. You pay a large amount of tax. And if most of your wealth is tied up in property and super, your cash flow may still feel tighter than people expect. This is also the stage where lifestyle inflation becomes dangerous. Bigger mortgage, better car, private school fees, more expensive holidays. It is surprisingly easy for a household earning $250,000 a year to still feel financially stretched. Level 6. Top 5%. To reach the top 5%, you usually need around $3 million to $4 million in net assets. This is where wealth really begins to compound. You may own your home outright, or be very close to it. You probably have 1 or 2 investment properties. Your super could be sitting around $600,000 to $800,000. And you may have more than $500,000 invested in shares, ETFs, or other assets. At this stage, passive income becomes a real thing. Your investments might generate $50,000 to $80,000 a year from rent, dividends, or distributions. That is basically another salary coming in without you having to work for it. This is the point where you stop trading time for money and start letting your money work for you. Level 7. Top 1%. To be part of the top 1%, you need around $8.3 million in net worth. If you are between 25 and 40 years old, that threshold is lower at around $3.1 million. For people aged 41 to 64, it is around $7.7 million. And for households over 65, the top 1% starts above $10.9 million. At this level, you are no longer thinking about weekly budgets. You are thinking about tax structures, trusts, asset protection, estate planning. You probably have an accountant, a financial advisor, and maybe even a solicitor helping you manage everything. Your retirement is sorted, your kids are sorted. You are now focused on building wealth that lasts across generations. Level 8, ultra-high net worth. And then there is the ultra-high net worth category. This is usually above $30 million in liquid assets. These are not ordinary high-income earners. These are founders, business owners, property developers, mining executives. The number of people in this category is growing, and the gap between them and everyone else is getting bigger every year. So where do you fit? And what would it take for you to reach the next level? Because when you step back and look at the full picture, one pattern becomes obvious. Wealth is not only about earning more, at least not in the beginning. It is about keeping more of what you earn. Then using that difference to build assets over time. Every wealthy person started with the same basic formula. Spend less than you make. Invest the gap. Repeat it for years. If you are at the bottom, understand that the system is difficult, but it is not impossible. If you are somewhere in the middle, you are probably closer than you think. And if you are already near the top, your biggest risk is not losing money. It is losing perspective. No matter where you are today, there is always another level above you. The first step is being honest about where you are right now. If you enjoyed the video, make sure you subscribe, and I will see you in the next one.